Okay. Can you hear me at the back? We have to put a mic on, so maybe the sound is a little bit better. Okay, great. Good. So I want to thank Shezna especially for inviting us. It's been a real privilege to be here today and in Macedonia. In fact, she asked me to, which is my favorite country in the world. I travel a lot, and she asked me to say Macedonia, but I'm very conscious that there's people from other Balkan countries here today, so I have to be a bit careful. I've been traveling for the last 3 weeks around the Balkans in 6 countries, and I've really had a lovely time in lots of these countries. It's a beautiful part of the world, so I'm very, very happy to be here. So a big thank you, and thank you to all of you to come here and learn about technical analysis. It's a real privilege for us to be able to share some knowledge, and hopefully it helps you. In terms of my work, I started trading options in the late 1980s, so I've been doing technical analysis for just under 40 years. I started a company called Updater. I do lots of training. I teach on part of the STA diploma course, so I'm one of the lecturers there, and I'm a member, of course, of the STA, IFTA, and the American Association of Professional Technical Analysts. I'm actually Australian, but I live in the UK. And I do a lot of research and R&D and speak at conferences, so I do a lot of this sort of thing. I read a book about charts, which I'm happy to say, I think it's the first donated book to the Society. So I was just trying to build a library of resources. So if people want to have a look at this today, maybe that it will be available ultimately in the library, so it's all about sharing the knowledge. So technical analysis has effectively been my life's work. It's all I've ever done. So the structure of this presentation, I mean, I've got about 80 slides, so I'm going to fly through the slides. My email address was at the beginning and at the end. I'm happy to send anyone the presentation so you can look at the slides more slowly, and I think I'm right in saying that you'll be able to re-watch this. So if there's things that you don't understand, I'm sorry for moving so fast, but also I'm here in the breaks and the lunch and the drinks, as is Trevor and Eddie and the other speakers. So we're more than happy to talk to you about technical analysis. Don't be shy. Come and say hello and ask us questions. That's why we're here. Use this opportunity because we won't be here tomorrow and the next day. So we're going to talk about some key concepts, the technical analysis tool set, combining tools, and then just with that knowledge, how we can then look at some charts. And unfortunately, I could just dive straight into the charts, but I'm going to look at some techniques that you may not have used before or heard of before. So I need to just give you a little bit of knowledge first. So the first thing I would say about technical analysis is price doesn't equal value. Price and value are just two different things. A valuation of a company or a valuation of an asset or a commodity is very different from what the price is. And if price did equal value, we wouldn't need a market. It would be very simple. We'd just say, that's the value, I'll buy it at that value. But the reality is price and value are two different things. So when people say to me, oh, that this stock is, the company is this value, I just say that's just not going to help you in terms of understanding price. Price is the true measure of something. And here, for example, this is a chart of WTI crude oil. It went to -40. I mean, how does that work? And if you understand the concept of delivery, at the delivery points, this was a moment at the expiry where suddenly this asset was worth -$40. I think you could have bet a lot of money with a lot of people in the market that would never happen, but it did. And what we can see is the price can go negative, or it'd be at $20, and then 2 years later be at $120. So it just shows you that the value didn't really change that much in that time, but the price really did. And so price is the true measure. The other thing is that the trend is your friend. I'm just sharing some concepts with you that hopefully are useful, some takeaways for yourself. And the trend is your friend until it comes to the end, of course. Yes, I'm not going to have time for questions.
No. I just want to clarify if that's okay. So the value is.
I have 80 slides in 45 minutes. I'm really not going to have time.
Second.
Can we do it in the break?
The value is relevant until the time you try to sell or buy. That's all I wanted to say.
I'm really not understanding what you're saying. Let's talk in the break. So the trend is your friend until it comes to the end, of course. And I've got a turkey here because there's a saying that even turkeys will fly in a strong wind. So it's basically, if the market is really strong and going up, a lot of stocks that maybe are not that good will also go because the strong wind is there. And the interesting thing is, this is a chart of German power, and in 2021 we were saying it would go from 54 euros to 97 euros. I do a lot of work in energy markets, and we kept saying it would go higher and higher. We gave a target of 462, it went to 524, and all the way up, these prices were unbelievable, but that's just what the technical analysis kept saying. The other thing that I always say to people is, what's your time horizon? And I've had already some good conversations with people here where they've asked me about crude oil, or they've asked me about, what's my view of this? And I always say, I can't answer this question until I know what your time horizon is. And this is the value of a conference. Ralph Ackenborough posed this question at an International Federation of Technical Analysts conference many years ago. And I took that little piece of information away. And that's the whole idea for you today, is that you can take little bits and they help you. So what's your time horizon is my first point. And I have this chart, it's actually in the book, but for me, medium term is where I'm looking at daily charts. And that means weeks ahead. So I'm thinking another 20 data points maybe on the chart is going to allow me to think out on the daily chart. If I want to think what's going to happen in the next few days, I'm only looking at a few data points on the daily chart. I need to go to the 60-minute chart because I've got more data, more granularity of data that's going to allow me to look at the next few days. And if I want to know what's going to happen today, in fact, I put our report out this morning. All of the last week, for example, on Brent crude, I've been bullish every day because the chart on the very short-term chart has been very bullish, and again this morning. And so the 1-minute chart is what I would look at for what's going to happen today, and maybe the 60-minute just to put that in the context. And then on the long term, you've got to start thinking about weekly charts, and then very long term, you've got to start thinking about monthly charts. Eddie mentioned monthly charts, and I had this conversation yesterday when I was talking, what is short term and long term? Because if you're a short term trader, long term is a few days. If you're a long term investor, short term is a few months. So different people have different time horizons, and this is also what makes the market. It's what makes the market function, and what's really interesting. So the technical analysis toolset is a huge body of knowledge in technical analysis, and I really suggest that as much as possible you get to understand the full toolset in technical analysis, because it's important to understand all the tools. But it's like you're not going to be able to undo a screw with a hammer, and you're not going to be able to nail a nail in with a screwdriver. You need the different tools. And the beauty of technical analysis is you learn the tool set and you can apply it to any chart. But if you're, as Eddie said, an F-word person, you have to know about every single company. And you have to know, all the different companies. You have to hold all that information in your head. By definition, that's out of date. That's the beauty of the charts. The charts are changing all the time. They're updating you all the time. You learn the tool set, you can apply it on different time frames. Once you have this knowledge of the tool set, you are equipped to apply it to any market you want. So it's really powerful in that regard, in a way that other firms, types of analysis are not. So in terms of chart types, we've got basically lots of different chart types, and I could spend time trying to teach you all of this, but I'm going to focus on two of the charts here, and I'll go into that in a minute. There's dozens and dozens of tools, and you can get as complicated with this subject as you really want. And we, as Eddie said, we like to keep things simple. That bottom middle chart is Andrew's pitchfork example. There's dozens of indicators, and once we got computers and we got all this computing power, we were able to go crazy and have hundreds of indicators and trading strategies. And my software has over 1,000 trading strategies built in. So it can be really daunting, and you do sort of need to cherry pick. So what I use, and I put it in this frame for you, is what I never use really is Elliott wave. I don't use swing charts. I don't really use moving averages. I find they're too slow, and there's quite a lot more that I don't use. Occasionally I'll use this middle group of things like candlesticks. I'll use these things. I'm aware of them. I'll watch them. But the things that I really use, and this is just personal, I've taken my essential tools out of the box and said, these are the tools that in order for me to go and do my job, I must have at least these top tools. So I use Dow theory, and I'll talk about that a little bit, key levels, price patterns, cloud charts, which is what this book was about, and point and figure charts. And so I'm going to talk just a little bit through the ideas. So Dow theory is really simple. This was Charles Dow, 120 years ago, invented the Dow Jones Index, founded the Wall Street Journal. So technical analysis is not at all a new subject. In fact, it was the news. You know, the ticker tape came out and people were effectively building charts in their head of price information. And then suddenly when computerization started happening, people thought that they could see the news and then buy the price. But in fact, the price has always been the news. And so what's interesting here is that if on the first chart, if we make higher than A, that's bullish. If we go lower than B, that's bearish. And most charts are in that place where we're waiting for a higher high or a lower low. And this is really what Charles Dow identified, the idea of a higher high and a lower low. And the great thing about charts is most things work in reverse. So the reverse of that is, if you look at the pattern going down, the lower low would be bearish, or a higher high than B would be bullish. So, for example, with Apple, right now, the question is, this chart is about a week old. The question is, will Apple go above $198.20, or will it fall through $171.90? This is the number one question for the biggest stock in the world. You can get everything else you read about Apple. It's not going to help you in terms of understanding what's going to happen with Apple. And it's just a really simple way of understanding price. But the other thing is this idea of the trend coming to an end. And if I look at this chart here, the people at A bought this, whatever it is, let's say it's wheat. They bought wheat at A, it went up to B, and then people at B sold wheat. And then at C, what's really interesting is that people were prepared to pay more for wheat than they were at A. That's how we think as technical analysts. It's just the fact that they were prepared to pay more at a later date. And then at D, it's sold at the same price as B does. That's what we call resistance. But just think about D. What's really interesting is that there are people who bought at A, saw it go to B, it fell back to C, and then when it got to D, they said, I should have sold at B. I'm going to sell at D this time. There are people at B who bought, watched it fall to C, it went back to where they bought it and say, thank God for that, I got my money back, I'm getting out. And then there were smart people who have been trading A to B, C to D. But what's interesting about the chart is there's lots of people along the way who've been trading it differently. And so then we get to break higher to F. So now we've got to a new territory. People are prepared to pay more than they've been previously. They're not selling at the level that they were at B and D. And then we fall back to G and we go, oh, that's a trend. I understand that. And then at H, something really interesting happens. People are now prepared to sell wheat at a lower price than they were at F. And then at I, we go lower than G, we fall lower than G, and then at I, people are now prepared to wait to buy it at a lower price. Now, this could be a 1-minute chart, a 60-minute chart, a daily chart, a weekly chart. It doesn't matter. The same principles apply. So this is the basis of technical analysis. It's where the balance of buyers and sellers are. And that's really what we're studying here. Why did they buy? Why did they sell? We really don't care. The fact is we're studying the effect, not the cause. We're studying what's going on. And if you think about price patterns, it's the same idea. So you move into a pattern, you've run, you get into a congestion zone, or we pause, and then we break higher. And so all of the people who sold in that pattern have got it wrong, and they've got to get out. And all the people who bought in that pattern were right. They can hang on. There's no pressure to sell. That's why price patterns work. It's the balance of buyers and sellers. And the same thing happens in reverse, bottoms and tops. So you get consolidation patterns, which are you move, you go sideways, you move again. You get reversal patterns, where you come into a price, you come out, you reverse, and you come back out the way you came. Consolidation patterns tend to happen more often than reversal patterns because the trend is your friend, and there will be a bigger trend operating quite often when you're looking at the shorter term trends. This is just to give you some understanding of price behavior, but now I'm going to talk about cloud charts. So this is a Japanese technique that was developed in the 1930s. It's quite a, has anyone seen these charts, cloud charts before? Yeah, good. So they're really simple. They're a bit complex to get to understand, but once you understand them, it's really powerful. And it's called in Japanese Ichimoku. Ichi means one, and look, one look, Ichimoku. So that's what it's all about. They were developed in the 1930s. As we've mentioned before, candlesticks were being used on the Osaka exchange 250 years ago, 270 years ago. So really, technical analysis has been used for centuries in Japan. And if you just look at where this fits in, basically in the 1930s, these were developed. But what's interesting, candlesticks came into charts in the 1980s. Steve Nyson wrote the book, and suddenly the Japanese technique was coming into major charts. Now nearly every chart you would look at would be a candlestick chart. And equally, these charts were developed decades ago and are only becoming popular in the last 10, 20 years maybe. So I first learned about them at the IFTA conference in Madrid. I think it's always important to say thank you. And Rick Bensinger, who did this presentation, I thought they were amazing. And I said to Rick, I want to write a book about it. And I gave him 6 years. And so I wrote the book and said, yeah. This is what one of these charts looks like. It's quite complicated, but I'll just quickly explain it. The construction is you have a turning line, which is a 9-bar midpoint. You have a standard line, which is a 26-bar midpoint, and then the cloud spans. And so 9, 26, and 52 are the key. Now, I should spend longer telling you all about the construction, but you can look at it on the internet. What you will learn on the internet is how they're constructed. What you won't learn so easily on the internet is how to interpret them and how to understand them. And that's the real point of coming to an event like this, is we can give you understanding rather than just feeding you the formula. There's no point in me teaching you things that you can easily go and find online. But and I do daily videos. I'll give details at the end. And we even have a training course you can learn about these. So cloud span A is literally where we shift that forward 26 bars ahead of the price. It's a really weird thing to do in terms of technical analysis. And then we shift the lagging line back 26 bars. And what we're really looking for is when we're above the cloud, we're bullish. And when we're below the cloud, we're bearish. So that's really just a mechanism for us knowing whether we're bullish or bearish, how we should be positioned. The trend is your friend, remember. So if you were buying over the last 10 years, if you were shorting Apple, you probably made a lot less money than if you were going long Apple, because the trend was up. So when you've got those trends in your favor, the trades will work out better. So this was actually WTI crude oil years ago, but it just shows how the price is above the cloud, then it's below the cloud, and then it's above the cloud. And so if you're in the cloud, this is really what we call the transition. If you're in the cloud, if you came in from above, you're bullish. If you came in from below, you're bearish. So it's determined by how you entered the cloud. The beauty of this is that when you see this transition through the cloud, so here we're seeing prices falling below the cloud, this is effectively trapping Dow theory. It's effectively finding that lower high, lower low, so that the cloud is showing you that that is actually occurring. And you might not easily see it, and the cloud just emphasizes it and keeps it in your head. So if you're below the cloud, you're bearish. If you're above the cloud, you're bullish. Now, one of the conundrums of technical analysis is that, generally speaking, the later signal will be the safer signal, but it will be less profitable. So in trading, you've got to understand this this relationship between being early and being eager and the risk of a failed trade, which is fine, but you've just got to understand there's higher risk, and then later, which is a safer signal, but you've already given up some of the profit. And so the lagging line is the confirming signal. It's safer, but it will cross the cloud later. So clouds are a roadmap. You're short when you're below the cloud, and you're looking to go long when you're above the cloud. It's just a roadmap. It's a tool to help you how you should be positioned. They don't work very well in sideways markets for the same reason that moving averages don't. In choppy markets, the construction means they don't work. You look at pattern. For example, here we've got a triangle pattern, a descending triangle. We break out of the triangle. We know that's bearish. We're below the cloud again. That suddenly the cloud starts working again. Then we go into a consolidation phase on the other end of this chart. We have to wait for the break from that consolidation phase before we can then say whether we're above or below the cloud. So why do they work? It's just a mechanism. It's just a mechanism. And basically, we're pulling the price. By pulling the price in front of itself and behind itself, it's making the bottoms and the tops a little bit keener than you would get with a moving average that's rolling over. And if you, we were saying this yesterday, if you find yourself saying, I should have bought there, that's quite often a buy signal because you can retrospectively spot a bottom. And if you say, I should have sold there, we suddenly get a bit religious and say, God, can you just put the price back there? And I promise I'll sell this time at that price. That's a sell signal. So it's just a mechanism for understanding that you can see the bottom, you can see where it happened, and you can see the top. So I've got a question. I want to just get a little bit of engagement before lunch. Is this an uptrend? Hands up who thinks this is an uptrend, this chart. Who thinks it's an uptrend? None of you think it's an uptrend. We've got 1, 2, 3, 4. Hand, or 5, 6. Any more an uptrend? Hands up who thinks it's a downtrend. The reality is nearly every chart you look at is in both an uptrend and a downtrend. So, you know, this is one of the things that when you first start learning technical analysis, you go, oh, it's a bit, you know, is it an uptrend or is it a downtrend? We have this joke all the time. Oh, there's 2 technical analysts going, I don't have time to stop, sorry. I'm running behind already. So is it an uptrend or is it a downtrend? And so the only time that you can perfectly say it's an uptrend is if it's making new all-time highs, and the only time you can say it's a downtrend is if it's making all-time lows. Nearly every chart will have multiple trends going on, and that's why we look at charts at different time frames. So we come back to that, and now we're thinking about the clouds. You know, if I want to think about 6 months ahead, I should be looking at the weekly cloud because that will go out 6 months. If I want to think a month ahead, that's 26 days. That's a daily chart. If I want to think about the hourly cloud chart, that's a few days ahead. And then there's the others on the side. So clouds just give us that ability to apply it. And here is, this was the NASDAQ a couple of weeks ago, and it was bullish on all the time frames, on monthly, weekly, daily, 60-minute, 10-minute, 1 minute, kind of rang a little bit of an alarm bell. It was just so bullish. But inevitably, the 1 minute chart can't stay bullish for very long. The 10-minute will follow quite soon after, then the 60. The daily will take longer to change, and the weekly will take a very long time to change. So you see the shorter term trends change. But one screen, I've got a whole view of what's going on with the NASDAQ in terms of the clouds. Bullish, 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 bullish. So I want to introduce a second technique, and 2 techniques are more powerful than one. It's the idea of having the hammer and the screwdriver. It means that you can do 2 jobs rather than just one. You're not limited by that one thing. And 2 opinions are better than one. These are just metaphors. 2 opinions are better than one. They agree. Different ideas point to the same conclusion. That's great when that happens. You know, the idea of standard deviation, you get 68% of the data in one standard deviation. If you have 2 standard deviations, you've got 95% of the data. Why bother with a 3rd technique? It's not going to give you that much more. Pareto principle, you know, 80% of the effort produces 20% of the results, 20% of the effort produces 80% of the results. So just by going to 2 techniques, it may be enough. And the tool set is yours to choose which 2 techniques you want to use. But I'm going to talk to you about point and figure charts. And this is quite hard to teach you in a short time, but it's just to show you that there are techniques that you may not have thought of or heard of. The book on this is written by Jeremy Duplessis, The Definitive Guide to Point and Figure. I've worked with Jeremy for many years, and I have to say I'm eternally grateful to Jeremy for introducing me to point and figure charts. He teaches at the STA, he teaches the point and figure module. He is really the world expert on point and figure. And this book, if you want to learn about point and figure charts, it's really a great book. So I really start using these charts. I got a bit jumpy there. So the point and figure chart looks like this, and it's reversals. It's an old shorthand before we had computers for recording price. And as I said, it's very hard to teach you this in a short amount of time, but they were basically used about 100 years ago. They're not used so much now in computers because we've got all these time-based charts. Why would I want to look at that old-fashioned chart? And I certainly, when I first started doing this, said, oh, that's the old-looking chart. I'm not going to use that. I wish I had changed my mind and used these. What's really powerful about them is they produce price targets, and that's what I'm going to show you. So the main features is that they're typically shown as cross noughts and crosses. There's no time scale, and I'll show you how that works. And we use what we call a box size, which is a unit of price. And it's an asymmetrical chart. But the key thing is that the trends and targets that you get from these charts are unique. It's all rules-based. I can push a key and I get the targets. So it was developed as shorthand. You can imagine all these prices are whizzing out of the ticker tape 100 years ago. And they had no way of recording this information. It's just coming out of the ticker tape. So what they did, just on the back of a cigarette packet, they would just write across, oh, we've just gone through $8. Oh, I see a 9 now. We've gone through 9, and they put another cross. And I don't know why my presentation seems to be jumping. So it was a necessary shorthand. And so then they realized that they were writing these numbers down, and they realized if they had a graph paper and a grid, they could just record these. And every time they reversed by 3, they would just jump across a column and go, oh, got a new reversal. And so that's really how they were developed. And the normal technical analysis principles apply, so patterns and key levels. But the interesting thing is it introduced new ideas like 45-degree trend lines. And these are, again, just drawn objectively off a low point or a high point. So the trend is decided at the low and at the high, rather than watching the price action to generate the trend. So it's really powerful. And you get these buy and sell signals. And so if you go up in the column, you pull back, then you go higher. That's what we call a double top buy, and then you get a double top sell. It's confusing terminology because double tops and triple tops and double bottoms, they're patterns in line charts, but in technical analysis, we call it a double top buy because we've gone higher. So it just is a little bit of confusion there. The idea is this idea of breakouts. So it's what we call the setup, where you go up, you pull back by at least 3 units, and then you go higher by at least 1 unit, just so you're clearly breaking higher. And that is the basis for how the targets are generated. And then you get the double bottom sell. And again, in the multiple time frames, we now think about units or box sizes in terms of the sensitivity of the chart. So if I'm looking at Apple, it's nearly $200. If I do a $1 chart, that's going to be 0.5% of the price. If I do a $2.50 chart, that's going to be less sensitive. And if I go to a 60-minute chart, I can use 10 cents. So by choosing the box sizes, and you'll see this when I come to look at some charts, we get a different answer. Now, the interesting thing about the 45-degree trend lines is that a trend is defined as 5 steps forward, 3 steps back. So, and those are really important numbers in Elliott wave. They're Fibonacci numbers, 5 and 3. But in order to have a trend, you've got to go 45 degrees and you're jumping across columns. You've got to have 5 steps forward, 3 steps back. Anything less than that, you're really not in an uptrend. And anything more than that, you're in a strong uptrend. The key thing is you get signals with a trend. So in a downtrend, you get more bearish signals, you don't get many bullish signals. In an uptrend, you get more bullish signals and you don't get many bearish signals. The problem with indicators, many indicators, is that in an uptrend, it'll keep telling you it's overbought. And in a downtrend, it'll keep telling you it's oversold. And there are things you can do to address that by moving your levels and things. But the reality is that indicators tend to give not so good signals in strong trends. Great for sideways trading, range trading. But if you're in strong trends, one of the problems with indicators is they give you the signals that you don't want. You want signals that are giving you opportunities to get in to a trend, not telling you to get out. Targets are about thrust. I mean, in England or Australia, we talk about cricket. We have a cricket ball. If you imagine a baseball, I don't really know what the equivalent is in the Balkans, but if you have a ball, a tennis ball or something, and you imagine pulling your arm right back and throwing it, if you pull it right back here, you can throw it a long way. But if you just do that, it's not going to go very far. So the bigger the thrust, the bigger the resultant move. Eddie mentioned this on crude oil. You have that move. The bigger that first move, the bigger the resultant move. It's just how we look at technicals. You've had more buyers off that low point, more buyers pushing the price higher. That's giving you more upthrust potential. That's what it's all about. You get this idea of activation and negation. So if we move below the low point, that whole setup is gone. That target is no longer valid. All those buyers have been negated, and the same happens in a downtrend. If you have move off the top, it's got a downside target, you go higher, it just undoes the whole target. So negation is a real factor, and activation, you have to move higher to activate that target. So if you imagine that setup, you've got to move higher than that first point there. You've got to move higher than that first point in order to be able to go to then activate the target. If you move lower than the base of that pattern, you negate it. Here's a chart. This was actually UK gas a while back, but the key thing here is that the point figure pattern, and what I'm showing you here is what it would look like on the line chart, and it's the same idea. We've got a target in one direction, we've got a target in another direction. It's whatever happens. If we go higher than A, we activate the upside target. If we go lower than B, we activate the downside target. It's just that simple. Targets clustering at the same level. So this was crude oil. It's an old chart now, but targets clustering at the same level where they're pointing to the same place increases the likelihood that that target is going to be met. Upside targets, if they're exceeded, that's really bullish, but quite often they're not met. You know, the target is a rough estimate as to what the price is going to do. If you don't quite get there, that's a little bit bearish, and if you exceed it, that's more bullish. So that's what we call bullish confirmation. And here we see some downside targets that were exceeded on another chart. So my typical screen is I'm looking at the long term, the medium term, the short term. And so I've got a weekly cloud chart, I've got a daily cloud chart, I've got a 60-minute cloud chart, I've got a 1% point and figure chart log scale, I've got a 0.5% point and figure log chart, and I've got a 0.1% 60-minute chart. And if any of you have ever seen Charts Today, I do this video, Charts Today, it's on chartstoday.com. I run through about, I would say, well, 6 charts times 40, I probably run through about 200 charts in 10 minutes. So, you know, I'm flying because, and it's one of the advantages, the more you do technical analysis, the more you just look at the chart and you can see it. And that's really the power of just doing this. It's the 10,000 hour rule. The more you do it, the more it just becomes naturally. So I look at 6 charts and I instantly have a picture of what's going on. So in this example, you know, I'm bullish long term, I'm bullish medium term, but I'm very short term. And that will then make me think about, well, I like this thing, but I'm not going to buy it until I turn bullish short term. Or am I going to live with the short term while I've got a long term position? In 2022, we said that at the beginning of 2022, well, at the end of 2021, we said that 2022 would be the year of the dollar. This is actually from a presentation on the 26th of November, 2021. We said it would be the year of the dollar, and it went up 21% in the first 9 months of the year. So it really ran. That's a massive move for the dollar. And then, of course, it turned a little bit bearish. And I'll talk about that when I get to some of the real charts. But the only reason I can say that was I was above on the daily. I was crossing on the weekly, which is a bullish confirmation. I had upside targets. And so it was just starting to look really good for the US dollar. One of the other things is that markets go through these super cycles. So here we see bonds tend to fall first, then you get stocks falling, then economic activity starts to go, and then whilst bonds and stocks are falling, commodities are rising. And the last one is precious metals. And I had some people ask me about gold. Well, we haven't got there yet. Gold's the last one to really start running. And that was an idealized chart. When you actually put the charts on, it's a little bit less clear. But this just shows how those trends look. And the bond markets, units are going up, bonds are falling. It's really clear that bond markets are falling. So I want to now just look at some charts just to finish up. So the US dollar, really quite interesting. It's starting to look a little bit better. It's crossed back on the daily. This is confirming what Eddie was saying about the euro. So the dollar is actually looking stronger again. So we've had several months of the dollar looking weaker. It's crossing on the daily. It looks like it found support on the lagging line on the weekly. So that's really quite good. And we've got multiple upside targets. You can see here we've got a downside target, but we've got more upside targets. So we're favoring the upside on the dollar. Notice how this target on the bottom chart of 113 was actually met. It was given below 100, and so it was met on the dollar index. So it just shows you how accurate the targets can be. Euro dollar is now starting to look weak. So euro against the dollar. And so, that's interesting because we're seeing that fall through the cloud on the daily. It's hit resistance on the cloud on the lagging line on the weekly. I've got a downside target here, and I think the picture, since I've done this, I've got some very long-term targets, which are quite scary for the euro. So I've kept mostly for the presentation to daily and weekly charts because I did this presentation a couple of weeks ago, and if I did 60-minute charts, they'd already be out of date. Just thinking about the Russian ruble, it's quite interesting. You hear the news, but whenever I hear the news, I want to go and look at the chart. I just think, anyone's view on what's going on. And here we're seeing the Russian ruble is now really seriously weakening against the US dollar, remembering that it's inverted. So this is how many rubles a dollar will buy you, and it's buying you more and more and more. So the Russian ruble is looking pretty weak. Turkish lira, just for people in this region, I mean, this was just unbelievable. And we had these targets and they've been exceeded. Remember, that's bullish. So that's been really key. China, really interesting things going on in China at the moment. Evergrande shares were down 25% overnight. They've just, China has got this property bubble, and you're hearing it all in the news, but 25% on a chart in a day, when I hear that, I want to look at the chart. Chart's been in a terrible downtrend. I mean, it's just awful. And so China might be just at a place, this is the yuan, and what's interesting against the dollar, we might start to see a real break higher here. We're above the cloud, we've got upside targets, and so really serious devaluation of the Chinese currency could be something that we will see against that. Don't forget that stronger dollar is also there to play. So this could be something we'll hear about in the news. Is this a black swan? What's going on in China? China process. Bitcoin, everyone wants to know about Bitcoin, right? So weekly, we're below the cloud. Daily, we're below the cloud. We've got these upside targets to sort of $50,000, but I'm really not buying those targets while I've got those trends. And that's the key thing. How do I know when to ignore the targets? Because of the trend. And so this is why you want to use two techniques. I've got the targets, I've got the other technique telling me about the trend. Bringing that together just gives me a little bit more power. And I've got a target there to $25,000. I haven't really looked, but we're probably there and already. So bond markets. This is a trend going back to 1982 of US 10-year treasuries. That is the end of a downtrend. That is just so picture clear. Notice that we didn't get to the top of the trend. That's bearish. So we didn't get to the top of the trend. That's a sign of bearishness. And then we went below the previous low a few years ago. That's really bearish. This long-term trend is basically the death of inflation. So inflation is coming back, and we're seeing this bond market chart is just, that's telling you that this is a big long-term change in the bond markets. Now you might see some short-term moves that are against this, but a long-term picture for bond markets is really grim looking at this chart. US bond yields, there's a target to 8.9%. It's hard to believe, isn't it? But that target's been there for a couple of years, and it was given, back at levels in the low threes. We've got one in the shorter term at 4.8%. And notice how this one at 4.24% was met. And notice the triangle pattern here. This is an ascending triangle pattern and basing pattern where people are prepared to pay progressively more for yield, and there's resistance holding it at bay, but it's going to break to the upside probably because of that power of the people paying more and more and more for it. So we're seeing that, and this is weekly and daily, so long term and medium term. Commodities. Notice how I can take the toolkit and apply it to different charts. This is the real power of technical analysis. You learn the subject and you are equipped to analyze any market. I know in this market it doesn't trade that frequently for a lot of things, and that means really that what we look at is a 60-minute candle, maybe, and something like Apple. You'll be looking at a weekly candle on some of the stocks in this market because you're not getting enough trades to actually produce a candle in a daily chart. There's no point looking at a 60-minute chart if it trades once a day. It's just, that's a fact. So crude oil breaking higher here, and as I mentioned on the short-term charts, and this is interesting, the daily chart, medium term has been bullish, and then every day last week when I was producing my energy report every morning on crude oil, I was bullish every day. And bullish again this morning, there are up some targets higher, and I'm looking at 1-minute charts for what's going to happen today, but it's interesting that the daily chart is confirming that picture. This is European gas, this is TTF, this is the Dutch gas contract. Having found the bottom, really quite interesting here, it's found a bottom, but it's failing to break higher. It's about 40, 42 euros. And at the moment, we've got a bit of a mixed picture. And this is the thing, is that recoveries can take a long time. And so it's not clear yet. And on the long-term chart, we're actually bearish. But I mean, if you heard the news about European gas, you go, oh my God, there's an energy crisis. But in terms of the charts, it's had its high and it's in long-term bearish territory. It might be just starting to cross into medium-term bullish territory, and I've got to watch the targets. And I look at a lot more charts to do that analysis. This is carbon. Actually, this has been weaker lately. Again, we've got a long-term picture that's quite bullish, but we've got a medium-term picture which is uncertain. We're going sideways. We've got to wait for the break, but it has been pretty weak. And I was bearish again this morning on carbon. Gold. So gold is long-term bullish, but that hasn't really helped you trade gold any time in the last year. It's been a really difficult one because it's in a really big range. Somewhere around $1,600 to $2,000, and until it breaks above $2,000, it's really hard to be really a gold bull. And Trevor mentioned these round numbers. $2,000 is the number that everyone has in their head on gold. And then we see here on the daily chart, we're bearish with a downside target. And so I've got a downside target of 9% and an upside target of 9%. And until we break to new highs, I'm just neutral really. But at the moment, within that trend, we're looking pretty bearish because we're below on the daily. So stocks, I can't really cover a lot of stocks. I'm not really making any recommendations here. Warren Buffett, he is, I think 42% of his portfolio is in Apple. It's quite an interesting one. And Trevor mentioned on the rotation graphs, interestingly, Apple is really falling off, and it's short term. is it going to make a lower low? That's really what we're watching for. There are some downside targets. And so this is what I typically look at when I'm looking at a screen. And this is, that's the thing, just waiting for what's going to happen. If Apple goes higher, it's, then we've got to target some 24% higher. So just waiting for that. This is a picture of my US tech portfolio. It's not by any means a recommendation. It just shows that I use stop losses, optimized stop losses. It's what I wrote my paper for on the International Federation of Technical Analysts. And this just shows that some stocks are in a hold, Apple and Microsoft. Some stocks are looking really strong. They're making new highs. A couple I've sold because they're below. So it's really, people always ask me, what are you doing? Well, that just shows you. But once I'm in a position, I'm typically using the stop losses because you can do the analysis, and the analysis is just going to tell you how you're positioned. And so the beauty of the stop losses is that it's a good, hard way of getting out. So the summary is that Forex, we're seeing that the euro is going to weaken against the dollar. I think that's now the picture for the year ahead. We're seeing that rise in the euro against the dollar over the last year is now coming to an end, and it's coming back to dollar strength. So that's just something for all of us in Europe. Bonds, well, you heard my view on bonds. Yields are going higher. Interest rates are likely to stay high. Inflation is probably likely to be sticky. I don't have any view on inflation. I'm just looking at what the bond yields are telling me about the market. Stocks, well, it's all about the US mega tech caps at the moment. That's what's really holding the market up. So, if Apple starts making new lows and other stocks starting to make new lows, that could be really bad for stocks generally. I think, if you take the top 4 or 5 stocks in the NASDAQ, you've got pretty much half of the market. And Apple is worth more than the whole of the UK market, which is a pretty big market. We may see an economic crisis. We're just seeing some signs. We saw what happened in Sri Lanka with currency. Italy's bond market, that could be quite interesting. And again, just looking at the charts there, and I mentioned China. Commodities, I think it's hard to see energy making highs above those highs that we saw at the start of the Russian crisis. Crude oil is looking quite bullish at the moment, but it's really got to break above the $100 mark and hold it for a few weeks to be confident that that's going higher. And then gold, we're just going to wait for 2,000. And I just think just think about some of the big global trends like electric vehicles, food. I watch all these things, but I'm always going to the chart. It's really important to go to the chart. So the opportunities in the market are, they're few and far between right now because we're not in a clear trend for a lot of things. So I finish by saying good luck. It happens in uptrends. So if you're a bull, that is. So good luck happens in uptrends. My email is there. It's david@updated.co.uk. If you would like the slides presentation, I'll happily send them to you because I appreciate I've moved through them really fast. Chartstoday.com, I record videos. On LinkedIn, I've got about 30,000 followers, so you can follow me there if you want to connect to me on LinkedIn. And thank you again. I hope this is helpful.